We're back with Bob Olstein of Olstein Capital Management. Bob, let's talk specific value stocks now. Give us some ideas of what you find attractive right now.
Well, what we find attractive is usually other people find in trouble, okay? But getting the right price is the key to long-term investing. Nothing else but getting the right price. Now, here's Bed Bath & Beyond, okay? Everybody hates it. Their margins are going from 12%, 11%. We think this company is real, it's relevant. The margins are going to drop to 10%. That's enough to produce $6 a share in free cash flow. The stock's $48. We like the problems because we get the right price. We think private equity capital can move right into the stock. I remember being on a network and talking about PetSmart. And they said, well, it's the internet that's killing them. Well, what's killing them is they're spending money to get in there. This company is the type of stock we have in our portfolio, undervalued, 10% free cash flow yield in a 2% treasury.
So when stocks are trading down, the average retail investor gets scared and starts selling them. Is that the time you start looking at them?
They sell them to us. That's what ones we want to buy. Now, you got to watch out for value traps, too. I mean, you can have a stock that's
Tell us what a value trap is.
A value trap is where the problem is not temporary like we think in Bed Bath. It is permanent, and basically you want to stay away from it because although it looks cheap, it's going to continue getting cheaper.
So the fundamentals are not quite what you think they are. It looks attractive on a valuation basis, but Gary, that stock is jammed in. It's never going to have an upward swing in earnings.
See, value is not determined by PE ratio. You can have a stock cheap at 25 times earnings, and you could have a stock expensive at 10 times earnings. You got to do your homework.
Let's talk about overvalued securities. You made a legendary call many, many years ago on Lucent when I believe it was the most widely held security among investors around the country.
Remember, it doubled after I made the call.
Telephone equipment company,
right.
Back in the, came public in the mid-'90s.
And
spun out of AT&T.
And then was a high flyer, crazy value. But as you point out, you were negative on it, it doubled, and then it eventually collapsed. When you look out there now, what are some of the names, Bob, that have the red flags, most overvalued? These are companies where the fundamentals are deteriorating and the stock price doesn't line up.
Well, I'm going to say it's Netflix right now. That, to me, is so unrealistic. They're in a competitive environment. They are spending billions. They had $120 million in earnings, and now we're not real earnings because they're adding stock compensation back, which is wrong. And they capitalized an additional $2 billion in programming. The analysts and the public's talking about new additions. I would worry about the $2 billion in negative cash flow.
So in simplistic terms, the fact is some investors are looking at the number of new subscribers that they're putting on the program. Your point is that they're putting them as subscribers, but they're actually losing money on a cash flow basis, adding all these new subscribers when you look at the business model.
The business model says they got to buy more and more programming because to keep their programming relevant. And you know, 20%, you're in the TV business, 20% of all expenditures on program make it. The other 80, they have $12 billion in future liabilities. This is crazy. This is one of those overvalued stocks in my history.
So Bob, back on the show in August, you were talking about and criticizing Amazon. They have a similar business model to Netflix. Stock's up 20% since then. So what would your response be?
Amazon, first of all, on that show, I said Netflix was the most overvalued. The stock was $129. Amazon, my concern there and why we don't play it is that they really, if you adjust the earnings for the fact that there's off-balance sheet, full payout leases with no cash flow, and basically they add back stock compensation, which to me is a financing, there's no free cash flow there. It's a great company, Amazon. They do have a good business model, but when they've gone from $4 billion to $135 billion in sales, and there's still no free cash flow.
So as a shareholder, you're looking for profit extraction from these businesses.
Eventually.
That reach your bottom line.
Right. Now, the bulls are saying they're going to push a button and it's going to become very profitable at some point in time. If they're right, then the stock is going to work. But basically, their business model is good. I buy all my goods on Amazon, but I wouldn't invest in it. It's too much risk.
If I don't know how to read a cash flow statement, I'm not an accountant, I don't read a balance sheet, but I hear what you're saying, and I'm concerned about this. How do I protect myself as an investor?
You can't. It's like Anthony's going to fly a plane. He's probably had 2 years of lessons. If you don't know what you're doing, find it. I don't build my own houses. I find a good house builder.
I just want to tell all my family members, you don't have to ever worry. I'm never going to be flying a plane. But let's go, because I understand risk management. Okay, so let's go to that part of your portfolio. Value investors are often applauded for their risk management. So what are some of your risk management tenets when you're thinking about investing?
Real simple. Free cash flow yield. We look at the free cash flow, and we're usually buying companies, whether it's a Legg Mason, which we own now, or a Keysight Technologies. All of these companies have 9% free cash flow. Now, why do they have them? There's a problem. But value companies, what's great about value companies is while you're waiting for the public to realize what's going on, you're adding to the value as the cash gets added to the balance sheet by a dividend, stock buybacks. So free cash flow is our safety.
Free cash flow doesn't lie.